Welcome to Wealthy Behavior, talking money and wealth with Heritage Financial, the podcast that digs into the topics, strategies, and behaviors that help busy and successful people build and protect their personal wealth. I'm your host, Sammy Azzouz, the president and CEO of Heritage Financial, a Boston-based wealth management firm working with high net worth families across the country for longer than 25 years. Now let's talk about the wealthy behaviors that are key to a rich life. Welcome to the October edition of the Wealthy Behavior Podcast, where I talk to our Chief Investment Officer, Bob Weisse, about what's going on in the market and investment universe you need to know right now. Bob, third quarter's in the books?
Third quarter's in the books, and it was a strong one.
Yeah, well, I know you're going to give us the details, but anything that jumps out at you specifically to start?
Nothing in particular, really. Overall, I would just label it as we are in a risk-on market, and it's basically been strong for all risk assets. Maybe the one thing that's a little more notable is overseas equities have led the pack, which we haven't seen too much in the last 15 years, and the returns there are quite strong. But I can run through the numbers year to date, maybe to kick it off.
Absolutely.
So looking at U.S. equities, these are year-to-date returns. The MSCI USA net up 15.12%. Looking overseas, MSCI World ex-USA, so developed international markets, up 27.28. So just pausing there, 27 and change for developed ex-US compared to about 15 for the US, so 12% outperformance from foreign developed. And then looking at emerging markets, MSCI emerging markets, net total return up 30.18%. So 30% year to date from emerging markets. So that's been quite strong. And then even bonds, which, we had a decade plus of near zero interest rates. So people, and then 2022, when rates rose and bonds were quite negative, bonds have not been really a place of getting meaningful returns in portfolios for some time. 6.39% from the Bloomberg US Aggregate Index. And it's through early October, so roughly 3/4 of the year. Not like should be doing cartwheels over a 6% return in light of what stocks are doing, but bonds are contributing. And for clients that are more conservative and have heavier allocations to bonds, that's not quite the headwind that we've been accustomed to back in the era of lower interest rates or rising interest rates. So overall, bonds are doing really well, stocks doing well, global stocks, foreign stocks doing even better. It's been quite a strong market for investors.
That's a great overview, Bob. Something that occurred to me, and I talked to Ken Shinoda from Double Line about it in the last episode, is that the bond market doesn't seem to really be reflecting concerns about the debt or the deficit. And he agreed that, a way to see whether those concerns were being reflected was to look at, how yields were doing, and particularly the 10-year or, longer term yields. So it just got me thinking, like, people worry about that stuff, and they've talked about it in the context of the stock market. But wouldn't the bond market really be what you should worry about if, as an investor, if you had concerns over our debt and our deficit? And it shouldn't necessarily cause you to be as sour on stocks as I think people are portraying periodically.
Yes, I think that was a good question, and I agreed with his response. I would look at long-term treasuries, at least 10 years and, going out 20, 30 years as really a good barometer for how much investors collectively are concerned about U.S. debt and deficits. And when you have the treasury yields around 4% on the long end, it's saying that there's not much concern. So I think for the most part, while there has been a lot of rhetoric around it, and I've contributed to that, there have only been glimpses of markets actually showing concern. It was, I think, 2 years ago in October that there were some treasury auctions where the demand wasn't really showing up, meaning yields were jumping up higher, but you've just seen little glimpses of it. But for the most part, markets aren't concerned about it. So we could talk about the government shutdown, which I would argue is, well, there's some just typical political disagreements that you'll always have in DC. I would say that the backdrop of heightened debt and deficits are contributing to the government shutdown, and it is around spending. And will that impact markets? So far, it has not, but could it? And if it does, is that debt and deficits impacted markets. I think you can connect the dots there to say potentially, but for now, it's not really impacting markets.
So before we get to the government shutdown, I think you had noted when we were preparing for this call another area of the market that was, risk on in the fixed income market, tight credit spreads, and you thought that was noteworthy. Why?
Yeah, when you look at market returns, we've had a good stretch here. I mean, overall, the last 15 years have been mostly up, and with really 2022, we had a little bump around COVID in 2020. But overall, it's been strong in the last 3 years, 23, 24, and calling 25 year to date have been quite strong. So it's always good to check in and just look at valuations, look at sentiment, and where are we in the cycle. You are hearing more comparisons to the late 90s of the tech bubble, and some people say it's 1997, others say it's 1999. So how do you measure that? And equity valuations are on the higher end, but I also like looking at credit spreads, and I think credit spreads are a pretty pure
Can you
way.
explain what those are real quick, Bob?
Yep. So if you can buy treasuries, which we just talked about, and treasuries have a certain yield, or you could buy, say, a corporate bond. And if you buy, for example, a triple B rated corporate bond, then there's more risk. There's a higher risk of default, and therefore you should expect a higher yield because a triple B bonds, may or may not pay you back in 10 years, whereas treasuries, the investors, as we just talked about, are pretty darn confident that they will get paid back. So that extra risk, it's called the credit spread, the extra return you get, and it goes up and down over time. It's a measure of how much extra compensation investors require for taking risk in the bond market. And just for example, going back in 2020 on triple B bonds, investors wanted about 4% additional yield from triple B bonds over treasuries. Now it's down below 1%. And it has not been below 1% on triple Bs since the late 90s. So even in the 2005, 6, 7 era, when markets got pretty frothy, it didn't quite break 1%. So I just think it's a pretty pure way of just measuring risk appetite from, call it Wall Street, from investors collectively. And right now, investors are stepping on the gas, risk on, seeking out risk, because you can purely measure how much you're getting compensated for it. And you also can measure the risk. Like triple B is how it's rated, and there's a certain default rate expected with triple Bs. And I know I'm picking on triple Bs, but it's across the bond market, whether you look at investment grade corporates or high yield corporates. The point is credit spreads have come in and they're at the very low end of the range, which means that investors in bonds who are taking credit risk are not getting compensated very well for that risk. So the takeaway to our listeners is in your bond portfolio. Sometimes we see people, what you could call chasing yield. So maybe you go on Morningstar if you're DIYing it and look for the highest yielding fund and think that, well, I want a bond fund that pays the biggest dividend, and that's what you buy. That's the one with the most risk typically. So that's a trap I see investors and some advisors fall into. Now's not the time, in our opinion, to chase yield because, well, you still get a little higher yield in these more credit sensitive instruments. Compared to history, it's on the lower end of the premium. So I think it's a better time to have your fixed income portion in higher quality assets.
Well, that's particularly noteworthy to me, Bob, that the spreads are so tight because you're getting an attractive yield on the high quality treasuries, right? So, I could understand if this was a zero interest rate environment and you needed, or you convinced yourself you needed to get 3, 4, 5% somewhere else. So you're willing to roll the dice a little bit. But it's harder for me to understand why spreads would be so tight when, the 10-year is quite attractive or more attractive than it's been in a long, long time.
I think that gets to the point because the people buying those, if they're really thinking it through, it's why are you buying a triple B at 5% when you can buy a treasury at 4%? And the answer is, well, I have a ton of confidence that it's going to be money good and 5's better than 4. I'm not concerned about the default risk. So as opposed to, yeah, I am concerned about the default risk, then I'd want 6, 7, 8%. So it's just a measure, a gut check of risk appetite and saying that risk appetite is high in the bond market.
Pivoting to something you were going to talk about, and you started to earlier, the government shutdown. I know so far the biggest thing that I've heard people talk about outside of the back and forth debate on who's to blame and what could happen is the delayed jobs report, right? We didn't get the September jobs report,
Right.
right? And so data is not coming through. That could impact investors. And then there's obviously the potential for more layoffs,
Yes.
and shutdown can have a negative economic impact. But investors are also concerned that it could get worse because so far it's basically been a non-event for the markets. But investors are concerned. You're sharing that you're hearing questions about what to do with your portfolio if this is a prolonged shutdown.
Yeah, I just thought we'd bring it up because I think a lot of our clients, watch the news, read the news, and are aware of current events, and it's certainly something that the media's given a lot of attention to. So the FAQ is government shutdown. What does it mean for my portfolio? What should I do? And I think you pretty much nailed it with everything you said. So far, markets have shrugged it off. We've had a number of shutdowns like this over the last 10, 20 years. It seems to be becoming more of a common event. And I think that's partly why the market, it's like, yeah, we've seen this play before, and eventually both sides will come to terms, and um, this will pass. But as far as risks, like you said, there could be more layoffs, and there is a cumulative impact to the shutdown and furloughs. So things like national parks being shut down, if that slows down travel, tourism, if people who are furloughed, they're not getting their paychecks, they're not spending as much money over as it extends. That does have an impact on the economy. So that part is real. And I would say that I think there's a good comparison to the government shutdown and tariffs back in April. So in both cases, that it's you could call it self-inflicted. Someone I know used the analogy of hand on the stove. Like with the tariffs, this case was the president put the hand on the stove and said, "We're imposing these tariffs." The market didn't expect it. Market went down, and then said, "Okay, we'll extend them for 90 days." Hand off the stove, and the market went up. This also is call it a self-inflicted political event that they control, that it can go away with a quick vote, or it can extend if they want to be difficult. Point is, it's unpredictable. I don't think anyone, maybe not anyone, that might be extreme, but certainly with tariffs, the market was not expecting them to be as severe when it came out, or them to be deferred the way they did and how it reacted. And I think there's the same potential for this one. So more kind of the caution of expect the unexpected, but just have your portfolio be positioned appropriately with the level of risk that is right for you. And it's nothing that anyone should be acting on, because unless you're some Washington, D.C. insider and you know what's going on, which you probably shouldn't be trading on anyways. That's a conversation for another day. It could move markets, but you shouldn't be changing your portfolio based on politics, because they're quite unpredictable.
So I'm just struck listening to this and processing our other conversations. Stock market's doing great, U.S. globally. The bond market is doing well. Credit spreads are tight. Bond market doesn't seem nervous about anything either. And then periodically we could say, oh, we've had a weak jobs report, or a government shutdown. We're gonna talk about foreclosures being up in a second. Do you think the market is too risk on, like whistling past the graveyard, or are these things that we should be talking about? Whether or not they drag markets down, it's just good to know that not everything is going perfectly well in the economy from time to time, and you just address them and move on.
Well, that's the big question, and I do lean towards it. It looks a little too rosy when you look at valuations in equities. We're not at 1999 levels, but there aren't many other times in history when we've been as high as we are. So the market, I think, is pricing in an accommodative Fed, a Fed that's cutting rates and will continue to cut rates, which typically, it is a tailwind for markets. But then you can ask, well, why is the Fed cutting rates? And you can dig into that a little more. But I think it's also priced in a lot of optimism around AI,
Yeah.
and that could. I mean, I do believe that AI is a valuable tool and will become a more valuable tool. but to what extent it improves corporate profitability, both in the call it nearish term, like say the next 3 years, and long term, 5, 10 years. I think that the jury is out because companies are spending a lot of money on AI, hundreds of billions of dollars of investment, and you need to see a return on investment, for that spend. And I think the market is kind of betting on the positive outcome. And but could this be more like the late 90s when everyone was investing in the internet and it's going to change the world? And they were right, but it didn't turn out to be a good investment in stocks in the late 90s if you measured it over the next 10 years. So I think that the jury's out, and it could go either way based on how much people are paying for companies at these valuations, that they're baking in a lot of good things to happen.
So that's your biggest concern because I think other things that we talk about, we mention, we address, I would say move on. But when I drilled next level with you, you brought up the valuations again, and you shared a note with me from a growth manager that you respect a lot and have allocated to in the past that would be, on paper, a manager, a money manager that would be very excited about the AI boom and has ridden those names. And that they were very cautious. I would say not cautious, concerned, really correcting my own self about the tech sector, comparing it to the .com era, saying that this ride could end and reverse soon. They see revenue growth decelerating, increasing competition, AI potentially disrupting the AI disruptors themselves, and that investors mistakenly think that these companies today are cheaper than they were in the 2000 tech bubble.
I mean, this podcast is called Wealthy Behavior, and just something that's always top of mind for me is when you're listening to any pundit, someone sharing an opinion on markets, understand what they do for a day job. And for example, if it's a bond manager and they're concerned about stocks, almost all bond managers are almost always concerned about stocks. Like you could say they're talking their book, or that just by nature they're more conservative people, but that's common. So if a bond manager says, "Oh, don't buy stocks, they're expensive," I take that with a huge grain of salt. You move into stocks, if it's a value stock manager, so someone who's trained to buy stocks cheap, and they're complaining about valuations in the stock market, again, that's kind of what they're always going to say because they're hyper focused on valuations and they don't like things that aren't dirt cheap. But when you have a growth manager who makes their living buying growth stocks, and one who say bought Nvidia 5 years ago and loved it and made a lot of money on it and specializes in growth stocks, and they're kind of waving the flag that this area is too hot right now, we're pulling back. That's what gets my antennas up. So, that's what you're saying, Sammy. It's a manager that we respect and I'd consider an expert in this space. And they cited valuations. And then the other big point that they're concerned about is the CapEx that I mentioned minutes ago, that companies are spending hundreds of billions of dollars on AI infrastructure. And for that to, really be justified in the stock prices today, they need to get a lot of increased productivity out of these tools, which is yet to be seen.
All right. Well, that's a great overview, Bob. And valuations, I think, are some things that investors should always be looking at. They don't give you short-term signals, but they can raise maybe the desire to make tactical, shorter-term moves, but more likely just tweaking your allocation, for the long run if you find other areas of the market that you think provide a better risk-adjusted return.
Yeah, and I think the takeaway for investors in this market is just be diversified. Don't get over your skis. When markets are going up like this, it's easy to say. I think I might have talked about this previously, but if a client has multiple accounts and one account say in all stocks, another account might have some stocks and bonds, and they need to withdraw money, well, they'll take it from the account with bonds because that one's lagging the stock account, and the stock account's so good, we don't want to touch that. Let that keep winning. That there's a tendency to do that, and I would just emphasize discipline. If on a scale from 1 to 10, you should be a 6 in risk, then just make sure you're a 6 in risk and rebalance, take profits. I'm not saying everyone go to cash or pile up on treasuries. It's just we frequently see people in these market cycles get over where they should be in risk and be okay with it because it's fun when it's going up. So that's my takeaway for investors in this environment.
Great. A couple more things. I noticed that foreclosures are up quite a bit, which got my attention. You wouldn't know this, but in 2008, the only serious investor I knew of personally who had raised concerns about what was going on without really any kind of actionable insight, but just stuff that he was seeing was making him nervous, was pointing to the fact that there was a lot of mortgage defaults in a time period where there really shouldn't have been, given how strong the economy was. And he was just this thought exercise. And he said, if things are going so great, this shouldn't be happening. And just reading this article about foreclosures being up kind of took me back to that. We've talked about a lot of good things going on. Why have foreclosures spiked in 2025? And is that something we need to worry about? I know you don't necessarily know the answer to that, but it is, I think, something that bears watching.
Yeah, I think that there's a few things. So when we look at economic data, really any market data, it's aggregate data. So it's take the whole pie and what's the snapshot. But when you slice it up, there are different demographics. Like so, for example, what could be happening in some environments is say wealthy people are spending a ton of money and kind of carrying the whole ship, and then the lower segment on the wealth spectrum isn't doing so well, and you wouldn't pick that up in aggregate data like a GDP print. So there can be splits, and I think that might be what's going on to an extent, because in consumer finance in general, like we've seen a tick up also in student loan delinquencies. So, and then we've seen a tick up in the unemployment rate. So it's up to 4.3%. It was in the mid threes not too long ago. So it's not, it's not a huge move, but you're still talking about a million plus jobs. So that does move the needle. So I think overall we have seen a softening in some of the credit reports, and my interpretation of it is that while it hasn't hit the aggregate data like S&P 500 earnings or GDP, it's that there's a bit of the haves and the have-nots in the economy today. And some people are doing well and spending a lot of money and carrying the economy, and others are not. And that's where you're seeing some of this data, because it's not everyone's, missing their mortgage payment, but a segment of the population is, and that segment that's missing is growing, just as the number of unemployed people has been growing. And that's why the Fed's cutting rates. And I didn't dig into it earlier, but with the Fed cutting rates, you can cheer that on and say, okay, this is a tailwind, but you can also say, wait a minute, why are they cutting rates? And I think it's for these very reasons that they're seeing a softening in the economy. The Fed does a good job with their regional governors digging in, and I think they're looking more at this type of data. And I think they're cutting rates because they see these concerns and they're trying to help out in these situations and give a tailwind. So the concern's real.
Great. I mean, not great that the concern is real, but great that you shared that overview. We were going to wrap it up by talking about gold because it's had I would say, quite nice of a run. And, you get more questions about it. Historically, my understanding of gold has been it doesn't necessarily do very well over the long run, despite having much more volatility than, or more volatility than stocks. So, volatility is a measure of risk, riskier than stocks. The returns can be quite weak over the long run. And then I think the thing that you noticed in preparation for this call was that there are definite periods of very strong and very weak returns that kind of roll into that long-term average summary that I provided.
Yeah, with gold, it tends to have these boom bust cycles where it goes on great rallies and then it goes nowhere or even down for an extended period of time. Statistically, the standard deviation of the price of gold, or basically the measure of its volatility or the measure of its risk, is high. It's higher than stocks. So with something that is statistically a roller coaster of an investment and tends to move in trends, meaning you say you have back-to-back, consecutive periods that are either really good or really bad. what typically happens in my experience is when you have these run ups where it does really well, it gets investor attention. And then clients are asking, hey, what about gold? Should I buy gold? And if I could do some study for the number of times I'm asked about gold and when those questions come up, the future return typically isn't very good because it bounces around. And when it's high, that's when people are asking, and then it's set up to not do very well. But stepping back, I mean, there's kind of a rule of thumb with gold that I mean, I haven't heard this too recently, but at least called the old adage was an ounce of gold should buy a fine man's suit. And if you think about that, it's basically saying that gold should deliver you the return of inflation. So if inflation over the next 100 years is 3%, gold should appreciate at roughly 3%. And people call it a store of value, and that's what it's doing. It's maintaining your purchasing power. It's not growing your purchasing power, but it's maintaining it. So you can buy a suit today, or I could give a piece of gold to my grandson, and he could buy a suit in the future. So if your expected returns inflation and the risk is higher than stocks, with investing, it's a risk return trade-off, and it's not a great trade-off. Like stocks, if I said, hey, for stocks, we're expecting inflation, people wouldn't buy them. Certainly not at the valuations today. You need to expect what's called a real return. A real return is the return above inflation. So you're taking a lot of risk. And the return is approximately inflation. If you look back, it does have these boom bust cycles. So like from 1970 to 1980, gold did very well. It went up many multiples. But then from 1980 to 2000, about 20 years, it had a negative return, like roughly negative 50% return. So 20 years of really dismal returns. Then it ramped up from 2000 to 2010 while stocks went nowhere. It had a great stretch, and then another decade of near zero return. So it has these very long, painful periods combined with these really high, strong returns. So my takeaway is it doesn't mean completely ignore it. We actually have a little sliver in client portfolios through a manager that has some real asset exposure, and they both have some precious metals, but also another way of investing in gold or precious metals is through the miners, because they, to some extent, are kind of a levered exposure to gold. So if it costs, call it $2,000 to produce an ounce of gold, and the price of gold is $3,000, there's $1,000 profit. If the price of gold goes from 3,000 to 4,000 an ounce, so a 33% increase, their profit went from 3,000 minus 2,000 to 4,000 minus 2,000. Their profit went up 100%. And in owning gold miners, you're owning companies that are earning assets that frequently pay dividends. So that's maybe I think maybe a slightly more reasonable way of owning gold without just owning the yellow metal and hoping it goes up. So if you do own it in a small amount is my caution, and also just don't chase performance. If you haven't owned it yet, after it's gone up really well over the last few years, now is probably not the time to buy, and it's probably not for you if you're honestly just chasing returns if you're asking about it today.
I appreciate that overview, Bob. And just to preview, in our next episode coming out in a couple of weeks, we're talking to a few of the advisors and professionals here at Heritage about their favorite piece of investment wisdom, kind of celebrating Heritage's 30th anniversary. So you're not on that episode because you're on every other episode. Do you have a favorite piece of investment wisdom to kick off this series?
Oh, wow. Putting me on the spot. So I would say it's more just the counterintuitive nature of investing that, I mean, the Warren Buffett quote, be greedy when others are fearful and fearful when others are greedy. I think there's a ton of wisdom in that. And it's easy to say, it makes sense, but in the moment, very few people tend to act that way.
Yep.
So I am fascinated by behavioral finance and the research behind it, and it gets to that. How the human emotion is just backwards with investing, and for better or worse, we're all humans dealing with financial markets. So whether it's communicating with clients or making investment decisions, I think there's a ton of wisdom in that quote.
Great. I appreciate the insight, Bob. And as always, I know our listeners love getting to hear from a chief investment officer managing a few $1 billion. So thank you for your help.
All right. Thanks, Sammy.
Thank you for listening to Wealthy Behavior. If you found the conversation useful, please leave a review wherever you listen to your podcasts and share this episode so those around you can live a rich life too. We appreciate your feedback and questions. Please email us at wealthybehavior@heritagefinancial.net. For more insights, subscribe to our weekly blog at heritagefinancial.net and follow us on Facebook, Twitter, and LinkedIn. Check out my personal finance blog at thebostonadvisor.com. Wealthy Behavior is produced by Michelle Kakamis.
This educational podcast is brought to you by Heritage Financial Services, LLC, located in the greater Boston area. The views and opinions expressed in this podcast are that of the speaker, are subject to change, and do not constitute investment advice or a recommendation regarding any specific product or security. There is no guarantee that any investment or strategy discussed will be successful or will achieve any particular level of results. Investing involves risks, including the potential loss of principal. There has not been and will not be any compensation exchanged between Heritage Financial Services and podcast guests or recommended resources.